Maybe we'll do one more and take a call. I think we can finish off. These are all small. The bigger ones we have already covered. Now we all have left with only chiller ones. Yeah. Now IND AS 113, fair value measurement. So many standards use fair value, right? Like biological assets are measured at fair value less cost to sell, right? Your non-current assets are measured at fair value less cost to sell. For revaluation model, you need fair value. So for many assets, you need a fair value. Impairment assets also, you need fair value. Correct. So hence they have devised a separate standard on how to calculate this fair value, or what are the things you need to keep in mind while calculating fair value. So there's just a standard which guides you on things to consider value, figure out what is the fair value. Okay, that's so fair value is basically, sir, amount received on sale of an asset or amount paid to settle a liability, excuse me, in an orderly manner in an orderly transaction between market participants on a measurement date. So fair value is basically amount received when you sell an asset or amount paid to transfer a liability in an orderly transaction between market participants on a measurement date. So that means in layman terms, fair value is nothing but exit price. To sell an asset, to settle a liability, right? So fair value we're talking about is the exit price. An orderly transaction means it should not be a forceful transaction. So suppose I put a gun to your head and say, give me this laptop at 10,000 rupees. Will you not give worth of that laptop maybe 1 lakh rupees? But obviously, if I have to put a gun on your head, I can get whatever price I want. Yes, no. So that's what they mean by that. It should be in an orderly transaction, not be a forceful. Okay, between market participants. Market participants means the knowledgeable buyers and sellers we're talking about. And fair value is true only on a particular date. If you find out fair value 10,000, no, that 10,000 is valid only for today. Tomorrow it could be something else. So hence fair value is activity is on a particular date. It's like balance sheet. That statement is true only for that particular date, like that. Okay. And if you have any entity specific restriction, they are ignored for fair value calculation, and asset specific restriction is considered. What is that, sir? So suppose I have a car. That car it's a yellow bird car. So that means I can use that car for rental purpose, meaning I can use it for commercial purpose. I use that car only for 4 hours a day. I don't use it beyond 4 hours. That is my entity wise restriction. So suppose somebody else buys me a car, somebody else buys the same car from me. Should you also use it for 4 hours only? No, if you want, you can use it for 8 or 9 hours also, or maybe 10 hours also. Yes. That means what? This is what sort of a restriction? This is a car's asset or car specific restriction or entity specific restriction? Entity specific restriction. That is ignored for fair value calculation. But asset specific restrictions are considered. Like let's say it's a yellow bird card, but I have taken only Karnataka permit. I have not taken All India permit. So that means the buyer of this car, can he take this car and let's say it's a Karnataka registered car. So can he take this car to Tamil Nadu or Delhi or Punjab or somewhere and use this car? No. He may suffer a heavy penalty or a car may be get confiscated. Yes or no? That means what, sir? That is asset specific restriction. That can be considered. That will be taken into account for your fair value calculation. But entity specific restriction is ignored. Always fair value is from market participant specific viewpoint, not entity specific activity. Okay. Next is a transaction. Sir, we always assume that the fair value, finding out fair value, so the transaction should happen. We assume fair value is asset sold, liability settled or not. So we assume that such a transaction, such a sale transaction or settlement wala transaction will happen in the principal market. This transaction, the fair value, will always happen in principal market. What is principal market? The highest volume market. And if principal market is missing, then we use most advantageous market. So we always assume this fair value transaction will happen in principal market. Principal market means the most voluminous market. Like suppose you have shares. Let's say we have Nestlé shares. Okay, Nestlé shares are traded in National Stock Exchange as well as Bombay Stock Exchange. Yes. Now you need to check Nestlé shares are traded in high volume in which exchange? BSE or NSE. If you conclude that NSE has a higher volume, if NSE has a higher volume, then NSE becomes principal market for finding the fair value of Nestlé shares. Like that. Fine, like that. So whichever has higher volume. So price will be same in both the market. No, not necessarily. There will be a minute difference. Yeah, fractional difference will be there between share price of BSE and NSE. Okay, so like that. That's for a different issue. Okay, so yes. So that's the principal market. Principal market means the highest value, highest volume market. That market which where these goods are traded in higher volume is principal market. If at all you feel you cannot conclude that which is a principal market, or if principal market is not there, suppose on NSE and BSE the volume traded is same. So if principal market is missing means then you will consider the most advantageous market. Most advantageous market means name itself is saying most advantageous. It is that market. Now, sir, fair value is defined from sale of asset. If you want to sell an asset, what is the most advantageous situation? To sell it at lower price or higher price? Higher price. So most advantageous market is that market that when you sell an asset, you will get maximum price. Or most advantageous market is that market when you are settling a liability, you have to pay the lowest price. That way. So whichever market gives you the highest price when you sell the asset, whichever market charges you the lowest amount when you settle a liability, that is your most advantageous market. Okay, sir? All right. Now, whenever you're finding out fair value from this principal market, most advantageous market, whatever, transport cost should always be added. Transaction cost should never be added. Transportation cost is always added. Transaction cost is not considered. Sir, why, sir? Sir, transport cost, no, sir, is necessary to bring the asset to that market. Let's say I have a biological asset, goat. I'm a goat dealer. Okay, I buy and sell goat. I use it for my business, or sometimes I sell it, etc., etc. So I own a biological asset, goat, which I want to sell it. But I'm there in Mandya. It's one of the places in Karnataka. Okay, so I am there in Mandya Gowdru. All right. But the principal market or the primary market or principal market, let's not say principal market, let's say primary, let's say principal only. So the principal market for this biological asset, let's say, is Bengaluru. I'm there in Mandya, but the principal market for this is Bengaluru. That means, sir, it is there in Mandya, it has to come to Bengaluru, so it has to travel. So that means if I have to sell this asset in the market, I have to incur this transportation cost. It becomes a necessary. Hence, transportation cost is always added for principal market. Transaction cost is something between an agreement between buyer and seller there. Okay, it's an individual thing there. Okay, it may be there, it may not be there. Hence, that is ignored for your fair value calculation. Transport cost is very much necessary because to conduct the transaction in that market, transportation cost you need to incur like that. Okay. All right. So let's take up one question in this, then we can proceed further. An asset is sold in two different active markets at different places. An entity enters into a transaction in both the markets and accesses blah, blah, blah. They're saying there are two markets data, A and B. The price that would be received in market A is 26. Transaction cost is 3. So do we need transaction cost? No, this data is irrelevant. However, the cost to transport is 2. Will we consider this? Yeah. Sir, if we sell the asset, we will receive 26. This is an asset we are talking about. Okay, not a liability. Sir, if we sell the asset, we will get 26. But to sell the asset, we have to incur a transportation cost of 2 rupees. That means the value is 24. Okay. In market B, the price received is 25. Transaction cost is there, ignored. And the cost to transport is 2 rupees. Probably should be considered. What would be your answer or your equation to calculate? The fair value of the asset if A is the principal market. Sir, if A is the principal market, how do you calculate? That means B ka data you ignore, consider only A. So A curve, using A curve market, you need to find out fair value. For fair value, will we consider transaction cost? No, we'll only consider transportation cost. That means what will be the fair value? Price received is 26 minus transportation cost is 2. That means the fair value of that price for that asset is 24. Okay, if A is the principal market. Scenario B, the fair value of the asset you need to find out if none of the market is principal market. You can't find out the principal market, it is missing. Sir, if the principal market is missing, what we have to do? We have to find out the most advantageous market. We have to find out the most advantageous market. Most advantageous market means that market that when we are talking about asset. When we sell the asset, we should receive maximum price. Whichever market gives me the maximum price, that is my most advantageous market. So for most advantageous market, I'm talking about maximum price. So every cost should be considered. Transport, transaction cost, everything. To find out which is most advantageous market. Most advantageous market means that market where I'll get maximum price. So to find out maximum price, every cost should be considered. So if you sell it in A, how much will you get? You'll sell it for 26. You'll incur a transaction cost of 3 deducted. You'll incur a transportation of cost deducted. So you'll get 21. If you sell the same asset in B, selling price is 25. Transaction cost is 1. So 25 minus 1 and transportation cost is 2. Deduct that and you'll get 22. So you are getting higher price in which market? In A May you're getting 21. In B May you're getting 22. So that means what, sir? B is the most advantageous market. Correct? Because that is giving me the highest price. Now B is the most advantageous market. That means fair value is 22. To find out which is the most advantageous market, we will consider all the income, all the expense. Now you got to know which is the most advantageous market. Yeah, which is what? B. Now go to B ka market and then find out fair value. To find out which is the most advantageous among A and B, we consider all the cost. Now you got it. It is B. Now check B ka market data and using B ka market or market B, find out fair value. And to find out fair value, we will not consider transaction cost, but only consider transportation cost. So in market B, how much will you sell the price? If you sell it, how much will you get it for? 25. Transaction cost is ignored. What is the transportation cost? 2 rupees. That means the fair value in second case is 23 rupees. Like that. Okay, do remember, not confusing, right? To find out which is the most advantageous market, every cost will be considered. And once you find out the most advantageous market, go to that market and find out fair value. And for fair value, only transaction cost is reduced and not transaction cost. Only transportation cost is reduced and transaction cost is ignored. That. All right. Now coming back. Next is fair value of non-financial assets. Non-financial assets means your land and all that stuff. So when you have land, building and all, so it has multiple uses. Now assets and all don't like excuse me, your financial assets like debt or cash and all don't have much uses. But when you're talking about assets like land, building, they have multiple uses. Like land, you can use it for your residential purpose or commercial purpose or agricultural purpose also. Yes. That means which purpose should be used to find out, because for each purpose the value is different. No. So which purpose should be used? The standard says since these assets have multiple uses, you should consider highest and best use. Best and highest use I have written. You can also alter it as highest and best use. HBU you can make it. Okay. This high you should consider. If you have multiple uses, you consider the highest and best use among all the three. If you have multiple, compare the three and take the highest one. Highest and the best. But this highest and best use must be legally and physically possible. Okay. Now let's say the highest use is commercial purpose. If you use it for residential purpose, you will get 10 lakh. For commercial purpose, you will get 15 lakh. For agricultural purpose, you will get 12 lakh. But for sir, you are operating in one area where you cannot use it for agricultural purpose. Now let's say I have a land in Bengaluru. Can I start agriculture in that? No, obviously BBMP will not give permission for it. Sir, I own a land in residential premises. That means can I start a commercial activity in that? No. If you own a land in residential premises, you have to use it only for residential purpose, because government will not give you permission to run commercial premises. That means what? Though the highest and best use is commercial purpose, is that possible? Is it legally possible? No. That means your highest and best use in this case will be what? 10 lakh of residential purpose. Like, okay. If all the three were permissible means, then you will consider the highest and best use. In that case, it will be 15 lakh commercial purpose, like that. So highest and best use should be legally and financially possible. That is one. Okay. Okay. Next is fair value of liability. So far we talked about assets. Now the fair value of liability. So if you're filing a fair value of liability or equity, first check if direct quoted market price is available. Let's say Infosys, they want to find their own shares ka fair value. Infosys company, they want to find out the fair value of their own company ka share price. Should they have to look around? No, not necessary. Why? Sir, their own share price is already quoted in the active market. No, the share is already listed in BSE, NSE and all. So the quoted market price itself becomes fair value. Let's say Infosys share price is 1000. That means 1000 itself becomes fair value. You don't have to look anywhere else. No need to do any exercise. If the quoted market price directly will become fair value. Suppose quoted market price is not available. Suppose you are a private company or unlisted public company. So quoted price is not available. In that case, what to do? Check if a similar liability or equity is held by another party as an asset. Because standard assumes that it is easy to find out the fair value of the asset than fair value of liability. Because asset easily you can sell, sir. Liability or settlement is not that easy. That's the reason you're saying if you want to find out the fair value of liability or equity, check a similar asset is similar component, similar to asset and liability. Because for you it may be a liability, for another person it will be an asset. No. So check if a similar asset is held by another third party and fair value of the similar asset, is it available? If you say yes, it's available, that only you can take and adopt it as fair value of this liability. If you want to find out the fair value of this liability or equity, okay, check if a similar asset is held by another party, okay, and if that fair value of that asset is available. If it is so, same thing can be adopted for this liability also. So that is also not there. Similar asset is not there. Then what do you have to do? So then you have to use some valuation technique, income approach or market approach, and find it out. More about that we'll talk about it, okay. So valuation techniques are basically of three types. One is a market approach. Market approach means you will use competitor data and find out. So basically they use the price of an identical asset or liability. So if you are X limited, you have a competitor Y limited. If you want to find out your fair value, and if your fair value, if you're not able to find out Y limited ka fair value, if you know, you can use that and do some adjustment and get your own company ka fair value. That is your market approach. Use your competitor or market ka data and figure it out. That's one. Next one is cost approach. Cost approach is used not permissible. If you see liabilities here, I've not written cost approach. I've only written market approach and income approach, because cost here refers to replacement cost. Sir, liabilities you don't replace. Asset you replace. Correct? No. If you have an inventory, the inventory is replenished. It's over. Means you will buy it again. Yes. So, or if an asset is outdated, then you will replace it with another one by incurring a cost. So here cost refers to the replacement cost. Okay. So if to replace an asset, how much it will cost? That can be adopted as a fair value. That's another one. Okay. Or income approach. Income approach means, sir, if you have an asset, obviously you will get some future earnings from it. No? So present value of future earnings. If you have a liability, you will incur, you will have to settle that. That means there will be present value of future cash outflows. Find out the present value of that. Obviously, if you have an asset or liability, in future you may get some inflows or outflows. So find out the present value of that. That becomes your income approach ka data. Okay. So, but to do this valuation, sir, you need some data. That data we call it as inputs. To apply all this, we need some inputs. That we call it as valuation. And to do the valuation techniques, inputs are required. Sir, inputs, no, we say could be either directly observable inputs or unobservable inputs. Directly observable input means they are those inputs which are developed using market data. Directly observable inputs are those data which are directly taken from market, like LIBOR. You have seen in the lease payment. Lease was based on CPI, LIBOR, etc., etc. The LIBOR and all is entity-driven data. Did entity estimate that? No, it is available in the market. Yes or no? So if you are using P multiple, price earning multiple, LIBOR, CPI, and all that is market-specific data. So if you are using market-specific input, that we call it as directly observable inputs. However, if you are using unobservable input, means they are those which are developed by the entity. If entity only estimates the inputs or values, that we call it as unobservable inputs. Like, sir, cash flows. So like for value, news and all, we have to estimate, no? Correct? So how do you find out? Present value of future cash flows. Cash flows, who will get? Entity. So who has to estimate the cash flows? Entity. So entity doesn't have a base for that. Correct? No? So those data which is not available in the market, which the entity has developed on their own, that we call it as unobservable input. And I already told you this, fair value is a market participant specific activity. By keeping market participants viewpoint, you will find out this. Okay, that means maximum amount of directly observable inputs you will use to find out the fair value. Maximum preference you will give it to directly observable data. If directly observable data is not given, then you will take the unobservable data. So first preference always to directly observable. Okay, and inputs now, sir, can be put under three hierarchies. We call that as input hierarchies. That is value level 1, level 2, level 3. Input could be of level 1. You have various categories under that. Hierarchy is level 1, level 2, level 3. Level 1 means unadjusted inputs. Unadjusted input from the active market, we call it as level 1 inputs. Like, sir, suppose one company owns 22 karat gold. One company owns 22 karat gold. And obviously, in the market price of 22 karat gold is available. 22 karat gold and 24 karat gold price is available. Let's say market price of 22 karat gold is 10,000. Now one company wants to find out the fair value of 22 karat gold it owns. Correct? Should I have to do anything? No. Market may directly its price is available. So this we call it as level 1 input. Level 1 input. Okay. So basically level 1 input means unadjusted price from the active market. We don't have to do any adjustments. Take it as it is. So fair value of this also becomes 10,000 rupees like that. Okay. That is your level 1. So what about level 2? Sir, if you are doing any adjustments, then it becomes level 2 input. We are taking some data, we can't take it as it is. We take the data and if you do some adjustments, we call that as a level 2 input. Like here, suppose the company owns 20 karat gold. They don't own 22 karat gold, they own 20 karat gold. Obviously the karat is a purity level. We say 24 karat is more purer, 22 karat is less purer, 20 is less, even lesser purer, like that, right? So this company owns, let's say, 20 karat gold. But in the market, if you just check, we don't have price for 20 karat gold. We only have it for 22 karat gold. Yes, no, we don't have it for 20, we only have it for 22. That means the company has to take market price of 22 karat gold and do some adjustments. Only then they will get the fair value of 22 karat gold, 20 karat gold. So that means this becomes your level 2 input. So if you're taking the market data and doing some adjustments, then we call it as level 2 input. If you're not doing any adjustments and taking as it is level 1. If you're doing adjustments, level 2. Okay. So level 3 is unobservable inputs. Unobservable inputs means those inputs which are developed by the company using its own estimates. Okay, sir. So this is about all the concepts relating to IND AS 113, fair value measurement. I think we have a couple of questions. Let's run them by. ABC acquired 5% equity shares of XYZ for 10 crore rupees for the year 20X1X2. Okay, 5%. We don't get significant influence. We don't get control. No joint control. That means this is your normal investment, normal financial asset. Correct? No? If you purchase equity instruments of another entity, it's a financial asset. Yeah, you will measure this financial asset at what? Probably equity instruments. So you'll either go for FVTPL method. Yeah. All right. The company is in the process of preparing financial statements for 20X2, X3. You bought the investment last year. Now you are in 20X2, X3. And it is assessing the fair value at the subsequent measurement of investment made in XYZ. So for second year, they want the fair value. Based on the observable input, ABC identified a similar transaction in which PQR, a third party, acquired 20% shares in XYZ for 60 crore rupees. So in XYZ, no sir, we are the shareholder. ABC owns some shares in XYZ. There is another investor called PQR. They had also bought some shares of XYZ, but they bought 20% stake by paying 60 crore. Okay. The price of such transaction was determined on the basis of comparable companies method. That is, enterprise value divided by EBITDA was 8. EV divided by EBITDA is 8. That means if you do it, enterprise EV stands for enterprise value is equal to 8 times the EBITDA. EBITDA means earnings before interest, tax, depreciation, amortization. Earnings before interest, tax, depreciation, amortization. So basically the value was determined. this 60 crore, no, that for this 20%, they paid 60 crore. The 60 crore was determined on the basis of 8 times the EBITDA. Whatever the company had the EBITDA, 8 times of that was paid. Okay, that's what they say. Alright, for the current year, the EBITDA of the company is 40 crore. For the year we want to find out fair value, EBITDA is 40 crore. So you already know what is the enterprise value. They only told enterprise value is 8 times EBITDA. EBITDA for current year is 40 crore, means 8 times of that. 40 into 8 is how much? 320 crore. That is the value of the whole company, not our shares. The whole company. Enterprise value means whole XYZ ka value. Enterprise ka whole value is 320 crores. Done, sir? Okay. Sir, we own whole company. Yeah? No, we own only 5%. So calculate 320 ka 5% is how much? 16 crores. Any other data is given? At the time of acquisition, the valuation was determined after considering 5% of liquidity discount and 5% non-controlling stake discount. So when they did this valuation, they did not adopt the value as it is. They took 5%, they reduced 5% because of liquidity discount and 5% non-controlling stake discount. Okay, so basically like they've reduced the 10%. Liquidity discount means probably this company is not a listed company. So if you buy this company ka shares, at some point of time, if you want to sell it, so if it's a listed market, easily fatafat you can sell off, right? But if it's unlisted company, it may be a little difficult to sell it. So hence they are taking a 5% liquidity discount and 5% non-controlling interest wala stake. Okay, two discounts they have reduced it. So us also we have to reduce. We can't take 16 crores as list. We can't take 320 ka 5% because 10% liquidity discounts were reduced. 5% NCI ka and 5% liquidity ka. Put together 10% discount was considered. So 16 crore ka 10% you calculate, which is what 1.6. That means what will become? You get 14.4 crore. That will be the fair value of our investment. That's all. So using this as a base, they asked us to find out the fair value. So the fair value of the investment that we will show, the fair value of our 5% investment is, that is the fair value of ABC ka 5% investment exercise is 14.4 crores. Okay. All right. Very, very simple. Yes. Okay. Next one is UK Limited is in the process of acquisition shares of PT Limited as part of a business reorganization plan. The projected free cash flow. Free cash flow means those cash flow which is available to pay dividend and debts. The cash flow from which you can pay debts and a dividend. Basically, debt is your debenture holders. Okay, so the money available to pay the debenture holders interest, maybe some principal also, and some dividend to the shareholders is what we call it as free cash flow. So free cash flow there for the next 5 years they have given. Okay, these are your future cash flows. They will give you a discount factor. So what we need to do? Find out the present value. They have given terminal value also. Terminal value means at the end of the year. So do not forget to consider this. Weighted average cost of capital. So discount factor is 11%. Debt value is 1465. Cash value is 106.64. The total number of shares on the measurement date is 8 crore 52 lakh 84,223 shares. Okay. You need to find out the fair value per share. In the previous problem, we found out the fair value of whole investment. Now they're asking, we want the fair value of per share. One share ka fair value they're asking using income approach. So income approach, how do you do it? Just take the cash flow, free cash flows, whatever they've given. Here they've given, no, including terminal cash flow, everything, multiplied by the discount factor. Discount factor here is 11%. So multiply. You will get the total present value to be, this is our, we multiply. I think this is, they have considered terminal value separately. What you do is fifth year ka you add these two and then find out discount factor. It'll be easier. Okay. So this is your terminal cash flow. Okay, that they have got it. Okay. So if you add all of this cash flow, all the years ka cash flow, total present value of cash flows you're going to get is 3105.76. Sir, this is free cash flow. Now we are talking about acquiring the shares means equity shares. Is this 3105.76 free cash flow available for entire for equity shareholders? No, they said this is free cash flow. Free cash flow means that cash flow which is available for dividend and debt. So that means a portion of this belongs to the debenture holders also. Debt means debenture holders. How much is the value of the debenture? 1465. So reduce that because in 3105, 1465 relates to the debt. So reduce that. That is one. And you also have some cash, Also have some cash, correct? If after the debt holders are settled, the remaining amount belongs to equity shareholders, correct? And 106 extra cash is there, means that will also be given to equity shareholders only, because once in 3105, if debt holders are settled, means remaining entire amount belongs to equity shareholders. Plus any extra cash is there, means that also belongs. So if you have any excess cash, add. So that means totally you're going to get what's 1746.90 crores. All this data is in crores. This is the total value of investment. Total value of PT Limited. Okay. But they did not ask the total value of PT Limited. They asked value, what is the value of one share? And how many shares does this company have? They have 8 crore 52 lakh 84. So that means you write 8 point. They've taken full value. I think when you're doing calculation, you have to take in crores. This is in crores, no? So 8.5284223 crores this will be. Correct? So the total value of all the shares is 1.1746. And we have 8.52 crore shares. That means what is the value of one shares? divide these two numbers, you're going to get how much? 204.83. That is the value of one equity shares arrived as per the income approach. Okay. Yeah. So with this, IND AS 113 is also complete.